Well, students, till last class, we have finished some basics on finance mathematics, including bonds. In this class, we will introduce another financial security called stocks. Let us recall some concepts which we have already introduced in the previous classes. Assets can be purchased in two modes. One is in the physical form, like gold, biscuits, and ornaments, whereas such assets can also be bought in the form of documents like gold bonds and so on. Such documents are generally called the financial instruments. They are considered to be equivalent to the physical assets, and these statements, which are generally written on paper or in the form of electronic documents, that provides the holder the ownership of the stated asset or the cash flow. The financial instrument can be mainly categorized into two parts. One is the debt-based instruments and another is the equity based instruments. An example of a debt based instrument is a bond, which we have already discussed. An example of the equity based instrument is a stock. Whenever a business organization wants to increase their capital, they may invite investors through these two ways. In the debt instrument, the investors enter as lenders, whereas the company which issues these debt-based instruments, for instance, bonds, are basically the borrowers. Whereas in equity-based instruments like stocks, the company invites the investors as owners. This is the main difference between a debt instrument and a equity instrument. The business organizations who wants to raise their capital through equity will invite the investors through stock exchanges by issuing what is called the initial public offer. In short, it is called IPO. So the investors can be big institutions and general public. The entire capital of the company will be divided into n equal parts, and each part is called a share. A collection of shares obtained through the IPO is called a stock of the company. Stocks are traded in the secondary markets like NSE and BSE after the IPO is closed. Hence, a stock of a company is a security which defines the holder a portion of the ownership in the company. Let us try to understand the difference between the bonds and the stocks. As we have already seen, the main difference between bond and stocks is that the investors are lenders, whereas the issuers are borrowers in the case of bond. And in the case of stocks, the investors are actually holding a part of the ownership in the company as a shareholders. Thereby, they are entitled to get a part of the profit that is made through the business of the company. In the bonds, we have the concept called coupons. These are like interest payment, and this is in most of the cases predetermined both in terms of the coupon amount and the time of distribution. And therefore, the cash flow in the case of bonds, in most of the cases, it becomes a deterministic cash flow. Whereas in the case of stocks, we don't have any fixed coupon concepts. Rather, when the company makes profit, they distribute the net profit to the shareholders in the form of dividends. Say, every quarter, the management of the company conducts a general body meeting and publishes the financial results, where they will come up with the sale and net profit of the company for the quarter. Say, for instance, the net profit that they made out of their public shares is, say, 100 rupees, and there are 100 shares in the public market. Then each share will have the right of 1 rupee, right? So this 1 rupee will be fully or partly be given as a dividend. Say, for instance, 20% of it may be given as a dividend and remaining 80 will be reinvested in the business. This is just a illustration. So this percentages which has to be given as dividends and which has to be given reinvested in the business will be decided in the general body meeting in every quarter. In that way, the amount of dividend depends on the profit that is made by the company and the decision which is made by the general body meeting. Therefore, the dividend that you get is random in that sense, okay, both in terms of amount obtained as dividends as well as the time at which they give. Sometimes they may not give any dividend, all the money they may reinvest into the business, or sometimes the company performance is bad that it gives loss in a quarter or so, then you don't get any dividend. In the case of bonds, we have fixed maturity time, okay, at which we get the face value plus the lost coupon payment also. Whereas in the case of stocks, we don't have maturity at all. And therefore, the initial amount that you invested in the name of price of this share will stay with you unless you sell the stock in the secondary market. And last but not least is the liquidity risk. In the case of bonds, you can completely avoid the liquidity risk by not selling your bond in the secondary market, whereas you hold it till the maturity and get back your face value at the time of maturity. In that way, you are completely avoiding the liquidity risk. Of course, the credit risk is always there, but liquidity risk can be avoided in bond, whereas in stocks, liquidity risk cannot be avoided because there is no maturity date. Therefore, you can take out your investment only through the secondary market. That is, you at some point of time when you want to liquidate your stocks, you have to go to the secondary market and sell the stock. At that point of time, if the performance of the stock is bad or the overall market scenario is bad, then there is a chance that the current market price at that time when you go to sell your stock may be less than your purchase value. In that case, you will even lose a part of your initial investment. Therefore, credit risk cannot be avoided. How the stock price behaves? Well, the stock price obviously behaves in a random way because there are many buyers and sellers in the market, and therefore the stock price behavior is random. And what mainly governs the stock price movement is its performance. That is, when the business perspective of the company improves, the profit perspective improves, and the outlook for the future dividend also improves, and therefore the share price will tend to increase. This scenario happens when you ignore the other factors of the market. Let us see some real-time illustrations. Here I am showing you the price of a stock. Let us call it as stock 1. This is a real-time data I have taken from the NSE site. So the stock price was 500 on January 1, 2017. Its price was around 515 a year later, that is Jan 1, 2018. Then the price jumped to around 665 in again Jan 1, 2019, and then into Jan 1, 2020, it was around 736. So this is a very nice story. For instance, if you have put money on the 1st of January 2017, in 1 year, you would have got 3.2% return. Okay, that is because if you bought at 500 on 2017 and suppose you sold on 2018 January, you would have got 516 per share, and therefore you got a return of 3.2%. Whereas if you have not sold it here, but you held the stock till January 2019 and sold here, you would have got 665 around, and that amounts to 33% return in 2 years now. And suppose you have not sold it here also, but you held and sold here, then you would have got 736, that amounts to around 47.2%. The same, if you would have put 500 rupees on Jan 2017 in a government bond, say for 6.5% yield, you would have got around 604 rupees, okay, in 2020. Yearly compounding, you would have got this. So this is an illustration to show that why one needs to take risk. In the last slide, I have listed the difference between bond and stocks, where you would have sensed that there are a lot of risks involved in investing in stocks. But then the question is, why will we go for investing in stocks when there is a lot of risk involved in it? The reason is very clear, that there is a possibility. Please note that there is a possibility in getting much more than what you generally get in bonds. Okay, so bonds are, especially government bonds, are risk free. So therefore you are getting this amount by investing 500 rupees in a risk free instrument, whereas in stock you have much more scope for getting returns, but there is a lot of risk involved in it, as listed in the last slide. You can in fact see in another example. Okay, this is another stock. Again, I have taken the data from the NSE of the other stock, where I'm again plotting the stock price yearly. In 2017, the stock was at 350, and in 2018, it came to around 312. Thereby, you are actually losing minus 12% in this 1 year. And then the next year, that is 2019, it came to 184. Therefore, from here to here itself, you have minus 41 from here to here. And in 2020, it was around 46, which amounts to, from here to here itself, I'm not calculating right from the beginning, it is minus 75%. Okay, so you can see the kind of risk that is involved in stock. But if you carefully choose your stock and invest, then there is a scope of getting much better returns than riskless assets. That is the reason for why many people go for equity investment, that is investing in stocks. Okay, next is, in all these plots, I have shown you only year wise. Whereas in between, if you see, I have just joined them by straight line. It doesn't mean the stocks trade only once in a year. They trade every day, and neither it means that they trade in a straight line. They trade in a very random way. As you can see in the next plot, I have taken this stock and plotted the daily price of the stock in this graph. You can see that on the 1st of January, this is Jan 1, 2019. So it started around 665. It was 665. And then daily chart, it shows the daily chart. So it means like this. Every day closing price I'm showing. So you can see that in between these two dates, that is 1st Jan 2019 to 1st Jan 2020, every day the stock closing price was like this. You can see the randomness involved in the stock price. You cannot predict this stock price accurately. Okay, there are many methods that can give you some idea of how things go, but nobody can predict this price movements accurately. Let us assume that you have 10,000 rupees in hand on 1st of Jan 2020. Assume that on this date, that is 1st of Jan 2021, you have to give this money to your friend. So you have committed this, that you have to give this money to your friend. Okay. Now, in this 1 year, you are going to keep your money ideally with you. Okay. So you can do either, you can put it in Almira and lock it, or you can put it in a savings account with 4% interest. First is just lock it. Second is you put it in a savings account which gives you 4%, or you can put it in a bond which gives you 6%. Okay, or you can also put it in this stock. Okay, now if I ask you what is the better choice among these four, obviously this is not a better choice. Okay, But among these three, because you at least have a better choice like this than this. Here you are getting 0% return, whereas at least here you are getting 4% return. Okay. In fact, when I ask whether this or this, you may go for this because this is also risk-free and this is also risk-free. Therefore, without any ambiguity, you will go for this. Of course, if it is a government bond, right? Otherwise, there is still a credit risk involved in this. Now, the difficult question is whether you will go between this bond or the stock. Because you see, so far the stock was performing well. What if all of a sudden it turns like this, right? Then you may be losing your money here. So it means you will be putting somewhere 736, 35 like that, and you will be getting around 680 or something. So you will be losing this money. Okay, and thereby you may not be able to meet your obligation, or you may have to put some money from your pocket to meet your obligation. Okay, so among these two decisions, it's very difficult. For convenience, let me put the same plot in a different frame and continue my discussion. So you are going to hold your money for this period. Okay. Now, if somebody can come and tell you whether the stock goes and touches like this, or the stock goes and will touch like this somewhere. Okay. Somewhere this side will be better for you. Ideally, you want this to be something, say, let us call this as S naught. Okay. This should be ideally something greater than S naught into 1 plus 0.06. Why 0.06? Because you have two choice, bond with yield 6% or stock 1. That is this stock, right? So one of these two choices you want to make. Okay. If this is something greater than this, that is, say your bond gives you this. Okay. Say bond gives you this. Now I want something like this, right? Then only I will prefer to put the money in this stock. Say, let us call this as S naught into U, where U is greater than 1 plus, let's call this as R. Okay, let's call this as 1 plus R. Okay, you want this. But it also gives you a possibility that it can go to S naught into D. That is the whole problem. Okay, so risk-free means what? It surely touches here. Okay, rather risk means there is a possibility that it may go here or it may come here, where D is less than 1 plus R. Okay. It may also happen like this. Now the question is, will you choose stock to invest? Well, it depends on your prediction on whether the stock goes up or down. Okay. In this course, we never go to predict stocks. Okay. Rather, what we do is we set up some mathematical tools that can rather help us to do prediction, or mainly our setup is to see how to price options for which the underlying assets are stocks like this. Okay, that is our main aim. So what we will do is we will try to set up a mathematical framework which can lead to some models that can help us to either predict the stock or price the derivatives. Okay. Okay. Before going into this setting up the mathematics, let me just show you what actually happened, because we already crossed January 1, 2021, and what this stock did, let us see. It was really a very happy ending story. It gave you around 71% return in 1 year, 71.2%. It means if you would have put your 10,000 here, okay, it would have given you around 16,328 rupees. It means you would have met your obligation by giving your friend 10,000 rupees, plus you would have earned 6,328 rupees, okay, in 1 year. That's a very nice thing. But you would have now understood how much risk involved in this, okay. So daily chart of this stock from, this is the January 1 price 2020, which is around 736, and the stock on January 2021, it was around 1,200. So you can see that it was not like this, growing monotonically along a straight line. It also had many downs and ups. You can see that because of the COVID factor, it fell very much, but then it picked up and went very nicely. Okay, so this is a nice story, but not every story is nice. If you would have chosen a bad stock, it might have happened in the other way. As I told you earlier, that it is not possible to predict market accurately. In fact, economists say that the prediction cannot be better than a sequence of head and tail obtained by tossing a coin. This unpredictability can be explained in terms of what is called the efficient market hypothesis. The hypothesis says that the current price of a stock always reflects all available information, and it will change only with the arrival of new information. It means what you see in the data that is already available, all the information that is known to the market is already factored into that. Okay, see, for example, if you take this is the daily chart of a stock. So when you are sitting here, what the efficient market hypothesis says, that whatever information that is known to the market till this time is already been factored in this data. It means as for this stock, there was some good news which is already been factored in. That is why the stock was going up. Okay. So from now onwards, whether the stock will further go like this or will go like this depends on the information that is going to come into the market in the future. Okay. So this depends on the information in future. Okay. For example, let us take here. We are sitting somewhere in March 15. Okay. So just before the lockdown on COVID, the stock was mostly going up, right? If you think that the market will further go like this only, that is wrong, because the information that COVID lockdown comes is coming somewhere here. Okay. And the market started reflecting that. So it completely forgot what was the information that was available previously, and it took the new information here, and thereby the stock crashed. Okay. So this is the efficient market hypothesis. You cannot see the past and then think that in future the stock will go up. Okay, you should always see what is the information that is going to come in future. But unfortunately, what information is going to come in future is not known today. Therefore, you cannot predict the market. This is precisely the reason why economists say that predicting market is no better than tossing a coin and deciding. Okay, that is whether the market standing here, whether the market goes up or down is something similar to what you predict before tossing a coin, whether you will get head or tail. And this is the basic idea behind what is called the binomial lattice model. We are given two parameters, D and U, such that D is less than U. Now, let S naught be the current price of the stock. Here you can see that we have completely forgot how the stock was going in the past. Okay, so we never care about it. We only worry about how the future is going to be. Now, in the future, that is in 1 times unit. So this is time t equal to 0, and this is say t is equal to say capital T. This can be 1 year, or it can be any time interval, 6 months or 3 months or even days. okay, 1 day or even minutes or seconds. At some time t, what we are doing is we are asking this question: what is the probability that the stock price is S of u, where S of u is S naught times u. Say for instance, u is 1.05. It means what is the probability that if you put money at t equal to 0 in the stock, which is having a price S naught, will give you 5% return in a time duration of t equal to capital T. So the question is, what is the probability that it does this? Okay. So once you have, say, probability of the event that the stock price touches SU is, say, P, then we will come to know what is the probability that it touches the, so we can take it as 1 minus P. It means it is something like, what is the probability that when you toss the coin, the head comes or the tail comes, right? So it's like that. Now in the binomial lattice model, we have to find what is U, we have to find what is D, and we have to find what is P. The binomial model is generally not very efficient if the time interval is too big, okay? Because say for instance, 1 year, it's not asking us to predict whether it goes up or not. It precisely asks us what is the probability that it will touch this particular number or it will touch this particular number, okay? So this may sound as if the probability is 0, because in this infinite interval, what is the probability that you pick up a particular number? The stock price can touch anywhere, right? Why only at this point? If you go back to this chart, you are sitting here and this is your S naught, and you are asking what is the probability that it will touch this particular point or it will touch this particular point. This is your SU and this is your SD, okay? If you take whether this interval or this interval, it is asking what is the probability that it takes this particular point in this interval or this particular point in this interval, okay? So it sounds as if the probability is 0, but then what we are doing in this method is that given that it is touching SU or SD only, then what is the probability? That sounds a bit unrealistic in the binomial lattice model. However, if the time frame is very small, say 1 minute or 1 second, probably it sounds to be more reasonable. Although it's not always true that in 1 second the stock price will not jump too much. Okay, it can even do, but as you go on reducing the time duration, then binomial lattice model looks more and more feasible. In fact, in the limit as capital T tending to 0, the binomial model is same as the Black-Scholes-Merton model. Therefore, understanding this model is very important. Now we have one more parameter, that is R. R is the prevailing interest rate. That is, for instance, you can take government 10-year bond yield as a reference and you can compare your performance of the stock with the return that you get from the bond, which is given by, suppose if R is the yield, then it is S naught into 1 plus R in 1 unit time, if R is the per period interest rate, or if you take the time interval as 1 year, then R is nothing but the yield. We always assume that 0 is less than D is less than 1 plus R is less than U. This is a very important assumption, and this is equivalent to saying that there is no arbitrage in the market. We will define the concept of arbitrage later, but now we will continue with binomial lattice model.